Welcome. Find a comfortable position. Take a slow breath. For the next little while, we are going to talk about taxes. Not in a stressful way. Not in a confusing way. Just quietly, calmly, one fact at a time. There is no rush here, and no exam at the end. Just information, drifting past you like a slow river. Let us begin at the very beginning. Fact 1. The word tax comes from the Latin word taxare, which means to assess or to value. Governments have been doing this for a very long time. Fact 2. The earliest recorded tax system dates back to ancient Sumer, around 3000 BCE. Citizens paid taxes in the form of labor, livestock, and grain. Fact 3. In ancient Egypt, the pharaoh collected taxes twice a year. Farmers were taxed on their harvests. Craftsmen were taxed on their goods. Everyone contributed something. Fact 4. The United States did not have a permanent federal income tax until 1913, when the 16th Amendment to the Constitution was ratified. Before that, the government relied mostly on tariffs and excise taxes. Fact 5. The very first income tax in the United States was introduced during the Civil War in 1861. It was only meant to be temporary, and was later repealed in 1872. Fact 6. Today, the Internal Revenue Service, commonly known as the IRS, is the agency responsible for collecting federal taxes in the United States. It was established in 1862. Fact 7. The IRS processes over 260 million tax returns and other forms each year. That is a very large number of documents moving through a very large system. Fact 8. In the United States, tax day, the deadline to file federal income tax returns, falls on April 15th most years. If that date lands on a weekend or holiday, the deadline moves to the next business day. 8 facts. 8 quiet pieces of history. We have been doing this for thousands of years, and we will keep going. Slowly, steadily. On to the next segment. Now that we know where taxes come from, let us look at the kind most people think about first. Income tax. The idea is simple, even if the details can sometimes feel complicated. When you earn money, the government takes a portion of it. How much depends on how much you earn. Let us explore that together, slowly and softly. Fact 9. The United States uses a progressive tax system. This means the more money you earn, the higher the percentage you pay on the portion of income above each threshold. Fact 10. Tax brackets are ranges of income that are taxed at specific rates. In 2024, the federal brackets range from 10% at the lowest to 37% at the highest. Fact 11. A common misconception is that if you move into a higher tax bracket, all of your income gets taxed at that higher rate. This is not true. Only the income above the threshold is taxed at the new rate. Fact 12. Your gross income is the total amount you earn before any deductions or taxes are taken out. Your net income is what remains after those subtractions. Fact 13. Taxable income is not the same as gross income. You can reduce your taxable income by claiming deductions, and the lower your taxable income, the less tax you owe. Fact 14. The standard deduction is a fixed dollar amount that reduces your taxable income. For the 2024 tax year, the standard deduction is $14,600 for single filers and $29,200 for married couples filing jointly. Fact 15. Instead of the standard deduction, some taxpayers choose to itemize. This means listing individual deductions such as mortgage interest, charitable donations, and large medical expenses. Fact 16. After calculating the tax you owe, you can further reduce it using tax credits. Unlike deductions, which lower your taxable income, credits directly reduce the amount of tax you owe, dollar for dollar. Brackets. Deductions. Credits. These are the 3 quietest tools in the tax system, and now you understand what each one does. Rest with that for a moment before we continue. Most people never actually write a check to the government for income taxes. Instead, money is taken out of each paycheck automatically. This quiet, invisible system runs in the background of every pay period. Let us look at how it works. Fact 17. Withholding is the process by which an employer deducts taxes from an employee's paycheck before the employee receives it. That money goes directly to the IRS on the employee's behalf. Fact 18. When you start a new job in the United States, you fill out a form called a W-4. This form tells your employer how much federal income tax to withhold from your paychecks. Fact 19. If too much is withheld throughout the year, you receive a tax refund when you file your return. If too little is withheld, you owe the difference when you file. Fact 20. Each January, your employer provides you with a W-2 form. This document summarizes your total wages for the prior year and the total amount withheld for taxes. Fact 21. In addition to income tax, most workers also have Social Security and Medicare taxes withheld. Together, these are called FICA taxes, which stands for Federal Insurance Contributions Act. Fact 22. Employees pay 6.2% of their wages toward Social Security and 1.45% toward Medicare. Employers match these amounts, effectively doubling the contribution to these programs. Fact 23. Self-employed individuals must pay both the employee and employer portions of FICA taxes, sometimes called the self-employment tax. This totals 15.3% on net self-employment income. Fact 24. Freelancers and self-employed workers are generally required to make estimated tax payments 4 times per year. These quarterly payments help avoid a large, unexpected tax bill at the end of the year. Fact 25. The Earned Income Tax Credit, or EITC, is one of the largest anti-poverty programs in the United States. It provides a refundable credit to low and moderate income workers and families. Fact 26. The Child Tax Credit allows parents or guardians to reduce their tax bill for each qualifying child under age 17. As of 2024, this credit is worth up to $2,000 per qualifying child. Fact 27. Contributions to a traditional IRA, individual retirement account, may be tax-deductible, depending on your income and whether you have a workplace retirement plan. This reduces your taxable income in the year you contribute. Fact 28. Contributions to a 401k retirement plan at work are made with pre-tax dollars. This means the money you put in is not counted as taxable income in the year you earn it. Fact 29. A health savings account, or HSA, allows people with high-deductible health plans to save money tax-free for qualified medical expenses. Contributions, growth, and withdrawals for eligible expenses are all tax-free. Fact 30. Student loan interest may be deductible up to $2,500 per year if your income falls below certain limits. This can provide modest relief for borrowers in the early years of repayment. Fact 31. Charitable donations to qualified nonprofit organizations are generally tax-deductible if you itemize. The deduction is limited to a percentage of your adjusted gross income. Fact 32. The American Opportunity Tax Credit helps offset the cost of higher education. It offers up to $2,500 per eligible student for the first 4 years of post-secondary education. Closing narration. Each of these is a small, quiet door in the tax code. A door that lets a little money stay in your pocket. They exist because Congress decided certain things were worth encouraging: retirement savings, education, charitable giving, and health. When a business earns money, it too owes taxes. The rules are a little different from personal income taxes, but the principles are the same. Earn money. Subtract eligible expenses. Pay tax on what remains. Let us walk through some key facts about how this works. Facts. Fact 33. A sole proprietorship is the simplest form of business. The owner and the business are treated as the same legal entity for tax purposes. Business income and expenses are reported on the owner's personal tax return using Schedule C. Fact 34. A limited liability company, or LLC, is a popular business structure. By default, a single-member LLC is taxed like a sole proprietorship. However, an LLC can elect to be taxed as a corporation if that is more advantageous. Fact 35. C corporations pay a flat federal income tax rate of 21% on their profits. This rate was set by the Tax Cuts and Jobs Act of 2017, which significantly reduced it from the previous top rate of 35%. Fact 36. S corporations allow business income to pass through directly to the owner's personal tax returns, avoiding the double taxation that C corporations can face. However, S corporations have strict eligibility rules. Fact 37. Business expenses that are ordinary and necessary for running a business are generally tax-deductible. This includes costs like rent, utilities, advertising, office supplies, and employee wages. Fact 38. Depreciation allows businesses to deduct the cost of large assets, like equipment or vehicles, over time rather than all at once. This reflects the gradual wear and use of the asset. Fact 39. The home office deduction allows self-employed individuals to deduct a portion of home expenses if part of the home is used regularly and exclusively for business. This can include a percentage of rent, utilities, and insurance. Fact 40. Businesses are also required to collect and remit sales tax in states where they have a taxable presence. Rates vary significantly by state and sometimes by city or county. Business taxation is its own quiet world, a world of ledgers and receipts, of expenses logged and deductions carefully claimed. It runs constantly in the background of every company, from the smallest freelancer to the largest corporation. Not all income comes from working. Some income comes from owning things, stocks, real estate, bonds. The tax treatment of this kind of income is different from wages. In some ways it is gentler, and in some ways it is more complex. Let us look at a few key facts. Fact 41. Capital gains are profits made from selling an asset that has increased in value. If you sell a stock for more than you paid for it, the difference is a capital gain. Fact 42. Short-term capital gains, from assets held for 1 year or less, are taxed as ordinary income. Long-term capital gains, from assets held for more than 1 year, are taxed at lower, preferential rates. Fact 43. For most taxpayers in 2024, the long-term capital gains tax rate is 0, 15, or 20% depending on income. This is often significantly lower than the ordinary income tax rate. Fact 44. Dividends are payments that some companies make to shareholders out of their profits. Qualified dividends are taxed at the lower long-term capital gains rates, while ordinary dividends are taxed as regular income. Fact 45. When you inherit an asset, you generally receive what is called a stepped-up basis. The cost basis of the asset is reset to its value at the time of inheritance, potentially reducing capital gains taxes if you later sell it. Fact 46. Property taxes are local taxes charged on the value of real estate. They are separate from income taxes and are paid to county or municipal governments to fund schools, roads, and local services. Fact 47. Homeowners who itemize can generally deduct up to $10,000 in state and local taxes, including property taxes, per year. This limit was established by the Tax Cuts and Jobs Act of 2017. Fact 48. If you sell your primary home, you may be able to exclude up to $250,000 in capital gains from your income if you are single, or up to $500,000 if you are married filing jointly, provided you meet certain ownership and use requirements. Assets accumulate quietly over years, over decades. And when the time comes to sell them, the tax rules determine how much of that gain you keep. Understanding these rules can make a significant difference over a lifetime. There is a quiet corner of the tax code that most people do not think about until they need to. What happens to your money and belongings when you are gone? How does the government treat the transfer of wealth from one generation to the next? These are questions answered by estate and gift tax rules. Let us explore them gently. Fact 49. The federal estate tax applies to the transfer of wealth from a deceased person to their heirs. As of 2024, the estate tax exemption is $13.61 million per individual. Estates below this threshold owe no federal estate tax. Fact 50. For estates that exceed the exemption, the federal estate tax rate can be as high as 40% on the amount above the threshold. This is one of the highest rates in the tax code. Fact 51. Married couples can combine their exemptions using a concept called portability, allowing a surviving spouse to potentially shield up to $27.22 million from federal estate tax. Fact 52. The gift tax applies to money or property transferred to another person without receiving full value in return. In 2024, You can give up to $18,000 per recipient per year without triggering gift tax reporting requirements. Fact 53. Gifts that exceed the annual exclusion must be reported to the IRS using Form 709. However, gift tax is generally not owed until your total lifetime gifts exceed the lifetime exemption, which is unified with the estate tax exemption. Fact 54. Tuition paid directly to an educational institution on behalf of another person is not subject to gift tax, regardless of the amount. This is a commonly used strategy for families funding education across generations. Fact 55. Medical expenses paid directly to a medical provider on behalf of another person are also excluded from gift tax. Like the tuition exclusion, this is separate from the annual gift tax exclusion. Fact 56. Charitable bequests, money or assets left to qualified charities in a will, are generally not subject to estate tax. Charitable giving at death remains one of the most common estate planning strategies. Closing narration. Estate planning is slow work. It happens over decades, in quiet conversations with lawyers and accountants, in documents carefully signed and stored. But understanding the rules is always the first step, and you have just taken it. We are near the end now. This final segment brings together some of the broader facts about the tax system, how the filing process works, what an audit really is, and a few closing thoughts about the role taxes play in all of our lives. Breathe slowly. We are almost through. Facts. Fact 57. There are several ways to file a federal tax return. You can file on paper by mail, use tax software, hire a tax professional, or use the IRS free file program if your income is below a certain threshold. Fact 58. The IRS free file program provides free tax preparation software to taxpayers whose adjusted gross income is $79,000 or less. It is available every year from January through October 15th. Fact 59. A tax audit is a review of a taxpayer's accounts and financial information to ensure everything is reported correctly. Most audits are handled by mail and involve a simple request for documentation to support specific items on a return. Fact 60. The United States collects roughly $4.4 trillion in federal tax revenue each year. This money funds defense, Social Security, Medicare, infrastructure, education, and many other government programs and services. Fact 51. Married couples can combine their exemptions using a concept called portability, allowing a surviving spouse to potentially shield up to $27.22 million from federal estate tax. Fact 52. The gift tax applies to money or property transferred to another person without receiving full value in return. In 2024, you can give up to $18,000 per recipient per year without triggering gift tax reporting requirements. Fact 53. Gifts that exceed the annual exclusion must be reported to the IRS using Form 709. However, gift tax is generally not owed until your total lifetime gifts exceed the lifetime exemption, which is unified with the estate tax exemption. Fact 54. Tuition paid directly to an educational institution on behalf of another person is not subject to gift tax, regardless of the amount. This is a commonly used strategy for families funding education across generations. Fact 55. Medical expenses paid directly to a medical provider on behalf of another person are also excluded from gift tax. Like the tuition exclusion, this is separate from the annual gift tax exclusion. Fact 56. Charitable bequests, money or assets left to qualified charities in a will, are generally not subject to estate tax. Charitable giving at death remains one of the most common estate planning strategies. Closing narration. Estate planning is slow work. It happens over decades, in quiet conversations with lawyers and accountants, in documents carefully signed and stored. But understanding the rules is always the first step, and you have just taken it. We are near the end now. This final segment brings together some of the broader facts about the tax system, how the filing process works, what an audit really is, and a few closing thoughts about the role taxes play in all of our lives. Breathe slowly. We are almost through. Facts. Fact 57. There are several ways to file a federal tax return. You can file on paper by mail, use tax software, hire a tax professional, or use the IRS free file program if your income is below a certain threshold. Fact 58. The IRS free file program provides free tax preparation software to taxpayers whose adjusted gross income is $79,000 or less. It is available every year from January through October 15th. Fact 59. A tax audit is a review of a taxpayer's accounts and financial information to ensure everything is reported correctly. Most audits are handled by mail and involve a simple request for documentation to support specific items on a return. Fact 60. The United States collects roughly $4.4 trillion in federal tax revenue each year. This money funds defense, Social Security, Medicare, infrastructure, education, and many other government programs and services. Fact 61. The alternative minimum tax, commonly known as the AMT, was originally created in 1969 after Congress discovered that 155 very wealthy Americans had paid absolutely no federal income tax that year. The AMT works as a parallel tax system that runs alongside the regular income tax. You calculate your taxes under both systems, and you pay whichever amount is higher. It was designed to ensure that high earners who claimed many deductions still contributed a minimum amount to the federal government. Fact 62. The United States is one of only 2 countries in the world that taxes its citizens on their worldwide income, regardless of where they live. This means that an American living and working in France, Japan, or anywhere else on Earth is still required to file a U.S. tax return every year and may owe U.S. taxes on the income they earn abroad. The other country that operates this way is Eritrea. Most nations only tax income earned within their borders. Fact 63. The foreign earned income exclusion allows Americans living abroad to exclude a certain amount of their foreign earnings from U.S. taxation. For the 2024 tax year, that exclusion is $126,500. To qualify, the taxpayer must meet either a physical presence test, spending at least 330 days in a foreign country in a 12-month period, or a bona fide residence test, meaning they have established a genuine long-term residence in another country. Fact 64. Tax expenditures are the collective name for all the deductions, exemptions, exclusions, and credits written into the tax code that reduce the amount of tax collected. The U.S. government estimates that tax expenditures reduce federal revenue by over $1.5 trillion every single year. That number is larger than the entire discretionary budget of the United States government, which includes defense, education, transportation, and most other programs Congress votes on each year. Fact 65. The concept of tax incidence refers to who actually bears the economic burden of a tax, which is not always the same as who writes the check. For example, when a business is required to pay a payroll tax, economists have long debated how much of that cost is quietly passed on to workers in the form of lower wages, or to consumers in the form of higher prices. The legal obligation to pay a tax and the real-world economic burden of that tax can fall on very different people. Fact 66. Roth IRAs and traditional IRAs both offer tax advantages for retirement saving, but they work in opposite directions. With a traditional IRA, you contribute pre-tax money, reducing your taxable income today, and then pay taxes when you withdraw the money in retirement. With a Roth IRA, you contribute after-tax money, meaning no deduction today, but all future withdrawals, including decades of investment growth, come out completely tax-free. Which one is better depends largely on whether you expect your tax rate to be higher now or in retirement. Fact 67. The step-up in basis rule is one of the most significant and most debated provisions in the entire tax code. When someone inherits an asset, such as stocks or real estate, the cost basis of that asset is automatically reset to its fair market value on the date of the original owner's death. This means that decades of unrealized capital gains simply disappear for tax purposes. If an heir sells the inherited asset immediately, they may owe little to no capital gains tax, regardless of how much the asset appreciated during the original owner's lifetime. Fact 68. Opportunity zone investments were created by the Tax Cuts and Jobs Act of 2017 as a way to encourage investment in low-income communities. Investors who place capital gains into a qualified opportunity fund can defer, and potentially reduce, their original capital gains tax. If the investment is held for at least 10 years, any new appreciation earned within the opportunity zone investment itself is completely excluded from capital gains tax. The program was intended to direct private investment into economically distressed areas across the country. Fact 69. The mortgage interest deduction allows homeowners who itemize to deduct the interest they pay on home loans up to $750,000. This deduction has existed in various forms since the federal income tax was introduced in 1913. It is one of the most widely used itemized deductions in the country, and it is also one of the most debated. Critics argue that it primarily benefits wealthier homeowners with larger mortgages and does relatively little to help first-time or lower-income buyers. Supporters argue that it makes homeownership more affordable and encourages long-term investment in housing. Fact 70. A 1031 exchange, named after Section 1031 of the Internal Revenue Code, allows real estate investors to sell a property and defer all capital gains taxes, as long as they reinvest the proceeds into a similar property within a specific time window. The investor has 45 days to identify a replacement property and 180 days to complete the purchase. This rule has allowed generations of real estate investors to build substantial portfolios by rolling gains from one property into the next, deferring taxes indefinitely as long as they keep exchanging. Fact 71. The IRS whistleblower program pays financial rewards to individuals who provide specific, credible information about tax fraud or significant tax underpayments. If the IRS collects more than $2 million as a result of the information, the whistleblower can receive between 15 and 30% of the total amount collected. The program has led to billions of dollars in recovered revenue. Awards are paid only after the IRS has fully collected the disputed taxes, which means whistleblowers often wait several years before receiving any payment. Fact 72. Taxes on cigarettes and alcohol are a specific category known as excise taxes, and they serve a dual purpose. On one level, they raise revenue for the government. On another level, they are deliberately set high to discourage consumption of products considered harmful to public health. These are sometimes called sin taxes. Similar logic has been applied more recently to taxes on sugary beverages, marijuana, and gambling. The idea is that by making something more expensive, fewer people will consume it, which ideally reduces the social and medical costs associated with it. Fact 73. The concept of double taxation comes up frequently in discussions about corporate profits. When a C corporation earns a profit, it pays corporate income tax on that profit. When the remaining profit is then distributed to shareholders as dividends, those shareholders pay income tax on the dividends as well. This means the same underlying profit has been taxed twice, once at the corporate level and once at the individual level. This is one of the main reasons some business owners choose to operate as S-corporations or LLCs, where profits pass directly through to individual returns without a separate corporate-level tax. Fact 74. The net investment income tax is a 3.8% surtax that applies to investment income, such as capital gains, dividends, and rental income, for taxpayers whose income exceeds certain thresholds. For single filers, the threshold is $200,000. For married couples filing jointly, it is $250,000. This tax was introduced as part of the Affordable Care Act in 2013 and was intended to help fund Medicare. It applies to the lesser of net investment income, or the amount by which total income exceeds the threshold. Fact 75. Tax loss harvesting is an investment strategy where an investor deliberately sells assets that have declined in value in order to realize a capital loss. That loss can then be used to offset capital gains elsewhere in the portfolio, reducing the overall tax owed. If losses exceed gains in a given year, up to $3,000 of the remaining loss can be deducted against ordinary income. Any losses beyond that can be carried forward to future tax years. Investors who use this strategy carefully can meaningfully reduce their tax bills over time without changing their long-term investment positions. Fact 76. The wash sale rule prevents investors from claiming a tax loss on a security if they repurchase the same or a substantially identical security within 30 days before or after the sale. The rule exists to prevent people from selling a stock purely to generate a paper loss for tax purposes, then immediately buying it back as if nothing happened. If a wash sale is triggered, the disallowed loss is not gone permanently. It is added to the cost basis of the repurchased security, which means the tax benefit is deferred rather than eliminated entirely. Fact 77. Payroll taxes and income taxes are collected through entirely separate systems. Income tax is determined by how much you earn and your personal tax situation. Your filing status, deductions, and credits all affect it. Payroll taxes, on the other hand, are flat percentages applied to wages up to a certain limit. Social Security tax applies only to the first $168,600 of wages in 2024. Income above that threshold is not subject to Social Security tax at all, which means that as a percentage of total income, higher earners often pay a lower effective payroll tax rate than lower earners. Fact 78. The term effective tax rate refers to the actual percentage of your total income that you pay in taxes, as opposed to your marginal rate, which is the rate applied to your last dollar of income. Because of the progressive structure of the tax code, most people's effective rate is significantly lower than their bracket rate. For example, a single taxpayer in the 22% bracket does not pay 22% on all of their income. They pay 10% on the first portion, 12% on the next, and 22% only on the top slice. Fact 79. The Inflation Reduction Act of 2022 included a new 15% corporate minimum tax on the financial statement income of very large corporations, those with average annual profits exceeding $1 billion. This was a response to the observation that some highly profitable companies had been reporting little to no taxable income for years through the use of various deductions and credits, even while reporting large profits to their shareholders. The minimum tax was designed to ensure that the largest, most profitable companies pay at least some federal income tax regardless of their deductions. Fact 80. Tax treaties are agreements between two countries that determine how income earned across borders will be taxed and which country has the primary right to tax it. The United States has income tax treaties with over 60 countries. These treaties often reduce or eliminate withholding taxes on dividends, interest, and royalties paid between residents of the two countries, and they include provisions to prevent the same income from being taxed twice. Without these treaties, international workers and businesses would frequently face the burden of paying full taxes in two separate countries on the same earnings. Fact 81. The estate tax exemption is scheduled to drop significantly at the end of 2025, when provisions of the Tax Cuts and Jobs Act of 2017 are set to expire. If Congress does not act, the exemption will roughly be cut in half, returning to levels closer to $7 million per individual rather than the current $13.61 million. Estate planning attorneys have been advising wealthy clients to consider making large gifts before the end of 2025 in order to take advantage of the higher exemption while it is still available. This creates a narrow but significant planning window for high-net-worth families. Fact 82. Unreimbursed business expenses used to be deductible for employees who itemized, but the Tax Cuts and Jobs Act of 2017 suspended this deduction entirely through at least 2025. Before this change, employees could deduct work-related costs like uniforms, tools, professional subscriptions, and unreimbursed travel to the extent they exceeded 2% of adjusted gross income. Self-employed individuals can still deduct these types of expenses directly on Schedule C, but regular employees lost this benefit entirely under the 2017 law. Fact 83. A qualified charitable distribution, or QCD, allows individuals aged 70 and a half or older to transfer up to $105,000 per year directly from an IRA to a qualifying charity, completely tax-free. This is particularly valuable because the distribution counts toward the required minimum distribution for the year without being included in taxable income. For retirees who do not need their required minimum distributions for living expenses and who give to charity regularly, the QCD can be one of the most tax-efficient strategies available. Fact 84. The backup withholding rate is 24%, and it applies when a payer, such as a bank or investment firm, does not have a taxpayer's correct Social Security number on file. In these cases, the The IRS requires the payer to withhold 24% of certain payments, such as interest, dividends, and freelance income, and send it directly to the IRS. This ensures that taxes are collected even when identification information is missing or incorrect. Taxpayers can avoid backup withholding simply by providing accurate identifying information on a W-9 form. Fact 85. The concept of constructive receipt means that income is taxable in the year you have the right to receive it, even if you choose not to collect it yet. For example, if your employer offers to pay you a bonus in December and you ask them to delay payment until January, the IRS generally considers that income taxable in December, the year it was made available to you, not January. This rule prevents taxpayers from artificially pushing taxable income into a future year simply by declining to pick up a check that is already waiting for them. Fact 86. Cryptocurrency is treated as property, not currency, for U.S. tax purposes. This means that every time you sell, trade, or use cryptocurrency to purchase something, you are potentially triggering a taxable event. If the cryptocurrency has increased in value since you acquired it, you owe capital gains tax on the difference. Even exchanging one cryptocurrency for another, say trading Bitcoin for Ethereum, is a taxable event. The IRS has made clear that failure to report cryptocurrency transactions is not a gray area, and has increasingly partnered with exchanges to identify unreported gains. Fact 87. The Research and Development Tax Credit, sometimes called the R&D credit, is a federal incentive that allows businesses to claim a credit for qualified research activities conducted in the United States. It was originally introduced in 1981 as a temporary measure to encourage domestic innovation, but it has been renewed and made permanent over the years. Qualifying activities include developing new products, improving existing processes, writing software, and conducting technical experiments. The credit can be particularly valuable for startups, which under certain conditions can apply it against payroll taxes rather than income taxes. Fact 88. Social Security benefits can be taxable depending on your total income in retirement. If your combined income, which includes adjusted gross income, non-taxable interest, and half of your Social Security benefits, exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, a portion of your Social Security benefits becomes subject to federal income tax. At higher income levels, up to 85% of your Social Security benefits can be included in taxable income. This surprises many retirees who assumed their Social Security income would always be tax-free. Fact 89. Transfer pricing is a set of rules that govern how related companies, such as a parent corporation and its foreign subsidiaries, price transactions between themselves. Because companies can manipulate these internal prices to shift profits to low-tax jurisdictions, tax authorities around the world require that intercompany transactions be priced as if they were conducted between unrelated parties at arm's length. Transfer pricing disputes between multinational companies and tax authorities represent some of the largest and most complex tax cases in the world, sometimes involving billions of dollars and years of litigation. Fact 101. The IRS has a program called the Offer in Compromise that allows taxpayers who genuinely cannot afford to pay their full tax debt to settle that debt for a lesser amount. The program is not a loophole or an easy escape. The IRS carefully evaluates each application by looking at the taxpayer's income, expenses, assets, and future earning potential. If the IRS determines that the offered amount represents the most it can reasonably expect to collect, it may accept the settlement. Many applications are rejected, but for taxpayers in genuine financial hardship, an accepted offer in compromise can provide meaningful relief and a fresh start. Fact 102. The term tax shelter originally referred to any legal investment or financial arrangement that reduced taxable income. Over time, however, the phrase became associated with aggressive schemes that pushed well beyond what Congress intended. In the 1970s and 1980s, elaborate tax shelter partnerships, often involving real estate, oil and gas, or farming, allowed wealthy investors to generate large paper losses that offset their other income. Congress and the IRS responded with increasingly strict rules, including the passive activity loss rules, which limit the ability to use losses from investments in which the taxpayer does not actively participate. Fact 103. The passive activity loss rules, introduced in 1986, were designed to prevent wealthy individuals from using paper losses from limited partnerships and other passive investments to offset their regular income from wages, salaries, and active business activities. Under these rules, losses from passive activities can generally only be deducted against income from other passive activities. If you have more passive losses than passive income in a given year, the excess losses are suspended and carried forward until you either generate enough passive income to absorb them or you sell the investment entirely. Fact 104. A tax lien is the government's legal claim against a taxpayer's property when that taxpayer has neglected or refused to pay a tax debt. A federal tax lien arises automatically when the IRS assesses a tax liability and the taxpayer fails to pay after receiving a demand for payment. The lien attaches to all of the taxpayer's property, including real estate, personal property, and financial assets. It can make it very difficult to sell property or obtain credit. A tax lien is different from a tax levy, which is the actual seizure of property to satisfy the debt. Fact 105. Alimony payments received under divorce agreements finalized before December 31, 2018 are generally taxable to the recipient and deductible by the payer. However, for divorce agreements finalized after that date, the rules changed entirely under the Tax Cuts and Jobs Act of 2017. Alimony paid under post-2018 agreements is no longer deductible by the payer and is no longer included in the recipient's taxable income. This represents a significant shift, and it is one of the reasons divorce attorneys often carefully analyze whether modifying an older agreement might inadvertently trigger the new rules. Fact 106. The kiddie tax rules were created to prevent high-income parents from shifting investment income to their children, who would otherwise pay tax on that income at much lower rates. Under current rules, unearned income, such as dividends and capital gains, received by a child under age 19 or under age 24 if a full-time student, above a certain threshold is taxed at the parent's marginal tax rate rather than the child's lower rate. The threshold for 2024 is $2,500. Income below that amount is taxed at the child's rate, but everything above it is subject to the parent's potentially much higher rate. Fact 107. Municipal bonds, often called munis, are debt securities issued by states, cities, counties, and other local government entities to fund public projects like roads, schools, and hospitals. The interest earned on most municipal bonds is exempt from federal income tax. For residents of the state that issued the bond, the interest is often also exempt from state and local income taxes. This triple tax exemption makes municipal bonds particularly attractive to investors in high tax brackets, who benefit most from tax-free income. The yield on municipal bonds is typically lower than comparable taxable bonds precisely because of this tax advantage. Fact 108. The self-employed health insurance deduction allows self-employed individuals to deduct 100% of health insurance premiums paid for themselves and their families directly from their gross income. This is an above-the-line deduction, meaning it reduces adjusted gross income regardless of whether the taxpayer itemizes. However, the deduction cannot exceed the taxpayer's net profit from self-employment for the year, and it is not available for any months in which the taxpayer was eligible to participate in an employer-subsidized health plan through a spouse's job. Fact 109. The concept of progressive taxation is often contrasted with flat taxation, where everyone pays the same percentage of their income regardless of how much they earn. Proponents of flat taxes argue that the system is simpler, more transparent, and more neutral. Proponents of progressive taxes argue that higher earners have a greater ability to pay and that taxing lower incomes at high rates creates hardship. Several countries have experimented with flat income taxes, including Estonia, Latvia, Lithuania, and Hungary. The debate between these two philosophies has been a central feature of tax policy discussions for well over a century. Fact 110. Deferred compensation arrangements allow certain employees, typically executives, to postpone receiving a portion of their earned income until a future date, often retirement. Because the income is not received until later, it is not subject to income tax until that future date. These arrangements can be valuable for high earners who expect to be in a lower tax bracket in retirement. However, they come with significant restrictions. Under Section 409A of the Tax Code, deferred compensation plans must follow strict rules about when and how distributions can be made, and violations can trigger immediate taxation plus a 20% penalty. Fact 101. The IRS has a program called the Offer in Compromise that allows taxpayers who genuinely cannot afford to pay their full tax debt to settle that debt for a lesser amount. The program is not a loophole or an easy escape. The IRS carefully evaluates each application by looking at the taxpayer's income, expenses, assets, and future earning potential. If the IRS determines that the offered amount represents the most it can reasonably expect to collect, it may accept the settlement. Many applications are rejected, but for taxpayers in genuine financial hardship, an accepted offer in compromise can provide meaningful relief and a fresh start. Fact 102. The term tax shelter originally referred to any legal investment or financial arrangement that reduced taxable income. Over time, however, the phrase became associated with aggressive schemes that pushed well beyond what Congress intended. In the 1970s and 1980s, elaborate tax shelter partnerships, often involving real estate, oil and gas, or farming, allowed wealthy investors to generate large paper losses that offset their other income. Congress and the IRS responded with increasingly strict rules, including the passive activity loss rules, which limit the ability to use losses from investments in which the taxpayer does not actively participate. Fact 103. The passive activity loss rules, introduced in 1986, were designed to prevent wealthy individuals from using paper losses from limited partnerships and other passive investments to offset their regular income from wages, salaries, and active business activities. Under these rules, losses from passive activities can generally only be deducted against income from other passive activities. If you have more passive losses than passive income in a given year, the excess losses are suspended and carried forward until you either generate enough passive income to absorb them or you sell the investment entirely. Fact 104. A tax lien is the government's legal claim against a taxpayer's property when that taxpayer has neglected or refused to pay a tax debt. A federal tax lien arises automatically when the IRS assesses a tax liability and the taxpayer fails to pay after receiving a demand for payment. The lien attaches to all of the taxpayer's property, including real estate, personal property, and financial assets. It can make it very difficult to sell property or obtain credit. A tax lien is different from a tax levy, which is the actual seizure of property to satisfy the debt. Fact 105. Alimony payments received under divorce agreements finalized before December 31, 2018 are generally taxable to the recipient and deductible by the payer. However, for divorce agreements finalized after that date, the rules changed entirely under the Tax Cuts and Jobs Act of 2017. Alimony paid under post-2018 agreements is no longer deductible by the payer and is no longer included in the recipient's taxable income. This represents a significant shift, and it is one of the reasons divorce attorneys often carefully analyze whether modifying an older agreement might inadvertently trigger the new rules. Fact 106. The kiddie tax rules were created to prevent high-income parents from shifting investment income to their children, who would otherwise pay tax on that income at much lower rates. Under current rules, unearned income, such as dividends and capital gains, received by a child under age 19 or under age 24 if a full-time student, above a certain threshold is taxed at the parent's marginal tax rate rather than the child's lower rate. The threshold for 2024 is $2,500. Income below that amount is taxed at the child's rate, but everything above it is subject to the parent's potentially much higher rate. Fact 107. Municipal bonds, often called munis, are debt securities issued by states, cities, counties, and other local government entities to fund public projects like roads, schools, and hospitals. The interest earned on most municipal bonds is exempt from federal income tax. For residents of the state that issued the bond, the interest is often also exempt from state and local income taxes. This triple tax exemption makes municipal bonds particularly attractive to investors in high tax brackets, who benefit most from tax-free income. The yield on municipal bonds is typically lower than comparable taxable bonds precisely because of this tax advantage. Fact 108. The self-employed health insurance deduction allows self-employed individuals to deduct 100% of health insurance premiums paid for themselves and their families directly from their gross income. This is an above-the-line deduction, meaning it reduces adjusted gross income regardless of whether the taxpayer itemizes. However, the deduction cannot exceed the taxpayer's net profit from self-employment for the year, and it is not available for any months in which the taxpayer was eligible to participate in an employer-subsidized health plan through a spouse's job. Fact 109. The concept of progressive taxation is often contrasted with flat taxation, where everyone pays the same percentage of their income regardless of how much they earn. Proponents of flat taxes argue that the system is simpler, more transparent, and more neutral. Proponents of progressive taxes argue that higher earners have a greater ability to pay and that taxing lower incomes at high rates creates hardship. Several countries have experimented with flat income taxes, including Estonia, Latvia, Lithuania, and Hungary. The debate between these two philosophies has been a central feature of tax policy discussions for well over a century. Fact 110. Deferred compensation arrangements allow certain employees, typically executives, to postpone receiving a portion of their earned income until a future date, often retirement. Because the income is not received until later, it is not subject to income tax until that future date. These arrangements can be valuable for high earners who expect to be in a lower tax bracket in retirement. However, they come with significant restrictions. Under Section 409A of the Tax Code, deferred compensation plans must follow strict rules about when and how distributions can be made, and violations can trigger immediate taxation plus a 20% penalty. Fact 111. The concept of tax neutrality refers to the idea that the tax system should not artificially distort economic decisions. A perfectly neutral tax system would not make you more or less likely to buy a home, start a business, get married, have children, or make charitable donations. It would simply collect revenue without influencing behavior. In practice, no tax system is fully neutral, because almost every deduction, credit, and exclusion in the code is designed to encourage or discourage some specific behavior. Economists debate endlessly about how much behavioral distortion the tax system creates, and whether that distortion is ultimately beneficial or harmful. Fact 112. The earned income of minor children is taxed at the child's own rate, not the parent's rate. If a teenager earns wages from a job, those wages are treated as regular earned income and taxed according to the child's own tax bracket, which is often zero or very low. This is different from investment income received by children, which is subject to the kiddie tax rules discussed earlier. Encouraging children to earn income through actual work and potentially contribute to a Roth IRA in their name is a strategy some families use to begin building long-term tax-advantaged wealth at a very early age. Fact 113. The IRS defines a hobby differently from a business, and the distinction matters enormously for taxes. A business is an activity carried on with the genuine intention of making a profit. A hobby is an activity done primarily for personal pleasure. If the IRS determines that your activity is a hobby rather than a business, you can still report the income, but you cannot deduct hobby expenses to create a loss that offsets your other income. The IRS uses a safe harbor rule. If your activity shows a profit in at least 3 out of 5 consecutive years, it is presumed to be a business. Horse breeding gets a more lenient test, 2 out of 7 years. Fact 114. The Low-Income Housing Tax Credit, known as the LIHTC, is the largest federal program for financing the construction and rehabilitation of affordable rental housing in the United States. It was created in 1986 and works by giving developers a federal tax credit in exchange for agreeing to rent a portion of their units to lower-income tenants at reduced rents for a period of at least 30 years. Investors, typically large banks and corporations, purchase these credits to reduce their own tax liability, and the money they pay for the credits provides the developer with equity financing. The program has financed millions of affordable housing units across the country. Fact 115. The term above-the-line deduction refers to deductions that reduce your adjusted gross income, and they are generally more valuable than below-the-line deductions. Above-the-line deductions are available regardless of whether you itemize, meaning anyone can take them. Examples include contributions to traditional IRAs, student loan interest, alimony paid under pre-2019 agreements, and educator expenses for teachers who spend their own money on classroom supplies. The line in question refers to the line on the tax form that separates gross income from adjusted gross income, and getting below that line is always a meaningful objective for tax planning purposes. Fact 116. Severance pay received from an employer is fully taxable as ordinary income. It is subject to federal and state income taxes, as well as FICA payroll taxes, just like regular wages. Some people are surprised to find that a severance package is taxed just like a paycheck, particularly when it comes as a lump sum that may temporarily push them into a higher tax bracket for that year. If severance is paid over multiple years rather than all at once, the tax impact can be spread out. Unemployment benefits, which are a separate matter, are also taxable at the federal level, though some states do not tax them. Fact 117. The concept of a Roth conversion involves moving money from a traditional IRA or 401k, where contributions were made pre-tax, into a Roth account, where future growth and withdrawals will be tax-free. The amount converted is treated as taxable income in the year of the conversion. This can be a powerful strategy in years when income is temporarily low, such as early retirement before Social Security begins, because the conversion is taxed at a lower rate than it might be later. Many financial planners advise clients to consider Roth conversions strategically during what is sometimes called the conversion window, the years between retirement and when required minimum distributions begin. Fact 118. The tax treatment of legal settlements depends heavily on what the settlement is meant to compensate. Settlements received for physical injuries or physical sickness are generally excludable from taxable income under Section 104 of the Internal Revenue Code. However, settlements for emotional distress, punitive damages, or lost wages are typically taxable. The distinction between physical and non-physical injury has led to considerable litigation over the years, as plaintiffs and the IRS have disagreed about how to categorize the damages in many cases. Careful structuring of settlement agreements can sometimes affect the tax outcome. Fact 119. The gift of appreciated property is a commonly used charitable giving strategy that offers a double tax benefit. When you donate stock or other appreciated assets directly to a qualified charity rather than selling them first, you avoid paying capital gains tax on the appreciation. You also receive a charitable deduction for the full fair market value of the asset on the date of the gift. This means the charity receives more, you pay less tax, and the transaction is more efficient for everyone involved than if you had sold the asset, paid capital gains tax, and then donated the after-tax proceeds. Fact 120. The Corporate Alternative Minimum Tax, which was reinstated by the Inflation Reduction Act of 2022, applies a 15% minimum tax on the adjusted financial statement income of corporations with average annual profits exceeding $1 billion. The motivation behind the provision was straightforward. Several of the most profitable companies in the United States had reported billions of dollars in profits to shareholders while simultaneously reporting very low or zero taxable income to the IRS, due to the use of accelerated depreciation, tax credits, and other provisions. The corporate AMT was designed to establish a floor beneath which no large corporation's effective tax rate could fall. Fact 121. Payroll tax holidays have been used several times throughout U.S. history as short-term economic stimulus measures. During a payroll tax holiday, the government temporarily reduces or eliminates the employee's share of Social Security taxes, putting more money in workers' paychecks immediately. The most significant recent example occurred in 2020 during the COVID-19 pandemic, when payroll tax deferral was made available to employers. Critics of payroll tax holidays argue that they undermine the dedicated funding stream for Social Security without being well targeted toward those who need help most. Fact 122. The luxury tax is a tax levied on goods and services considered non-essential and typically purchased by the wealthy. The United States experimented with a broad luxury tax in 1991, applying it to expensive cars, boats, aircraft, jewelry, and furs. The tax proved controversial and was largely repealed by 1993 after the boat and aircraft industries reported significant job losses as buyers shifted to foreign purchases or simply delayed buying. It stands as a cautionary example of how a tax designed to target wealthy consumers can unexpectedly harm the workers who manufacture the goods being taxed. Fact 123. The concept of tax brackets as we know them today in the United States has changed enormously over time. During World War II, the top marginal income tax rate rose as high as 94% on income above $200,000, the equivalent of well over $2 million in today's terms. For most of the 1950s, the top rate remained above 90%. It was reduced to 70% in 1964, to 50% in 1981, and dramatically to 28% by the Tax Reform Act of 1986, before gradually rising again to its current top rate of 37%. These historical shifts reflect dramatically different political philosophies about the appropriate role of the tax system in distributing wealth. Fact 124. The Lifetime Learning Credit is a federal tax credit that helps offset the cost of tuition and fees for post-secondary education, including graduate courses and professional development classes. Unlike the American Opportunity Tax Credit, which is limited to the first 4 years of college, the Lifetime Learning Credit has no limit on the number of years it can be claimed. It is worth up to $2,000 per tax return, calculated as 20% of the first $10,000 in qualified education expenses. The credit phases out for higher-income taxpayers and cannot be claimed in the same year as the American Opportunity Credit for the same student. Fact 125. The concept of basis shifting has become a focus of increased scrutiny from the IRS and Treasury Department in recent years. In complex partnership transactions, it is possible to use certain provisions of the tax code to eliminate or greatly reduce the taxable gain on appreciated assets by adjusting the tax basis of those assets in ways that may not reflect their actual economic cost. The IRS has identified several of these transactions as potentially abusive and has taken steps to require disclosure, and in some cases disallow the benefits. The area sits at the intersection of highly technical partnership tax rules and the broader question of what constitutes legitimate tax planning versus manipulation. Fact 126. The Solar Energy Tax Credit, formerly known as the Residential Clean Energy Credit, allows homeowners to claim a credit equal to 30% of the cost of installing solar panels, solar water heaters, wind turbines, and other qualifying clean energy equipment. The credit was extended and enhanced by the Inflation Reduction Act of 2022 and is scheduled to remain at 30% through 2032 before gradually stepping down. For many homeowners, this credit significantly shortens the payback period on a solar installation. Unused portions of the credit can generally be carried forward to future tax years if the credit exceeds the tax owed in the current year. Fact 127. The Foreign Account Tax Compliance Act, known as FATCA, was enacted in 2010 and requires foreign financial institutions to report information about accounts held by U.S. persons directly to the IRS. American taxpayers with significant foreign financial accounts are also required to disclose them on a form called the FBAR, the Report of Foreign Bank and Financial Accounts, if the total value of those accounts exceeds $10,000 at any point during the year. Penalties for failing to file the FBAR can be severe, reaching as high as $10,000 per year for non-willful violations and the greater of $100,000 or 50% of the account balance for willful violations. Fact 128. The concept of tax smoothing refers to the strategy of managing your income from year to year in order to stay in lower tax brackets and avoid large spikes in taxable income. Because the U.S. tax system is progressive, earning the same total amount of income spread evenly over several years results in less total tax than earning it all in 1 year. Self-employed individuals, retirees, and small business owners often have more flexibility to time income and deductions than salaried employees, making tax smoothing a meaningful planning opportunity for those who can manage the timing of when they receive or recognize income. Fact 129. Tax increment financing, or TIF, is a tool used by local governments to fund economic development in designated areas. When a TIF district is created, the current property tax revenue becomes the baseline. As development occurs and property values rise, the additional tax revenue generated above that baseline, the increment, is redirected to pay for infrastructure improvements, public facilities, or other development costs within the district rather than flowing to the general fund. The theory is that the development would not have happened without the public investment, so using the future tax gains to pay for that investment is self-financing. TIF has been used to fund everything from urban redevelopment projects to sports stadiums. Fact 130. The estate planning technique, known as a grantor retained annuity trust, or GRAT, allows wealthy individuals to transfer appreciating assets to heirs with little or no gift tax. The grantor places assets into the trust and receives fixed annuity payments for a set number of years. If the assets grow faster than the IRS's assumed rate of return, known as the Section 7520 rate, The excess appreciation passes to the beneficiaries tax-free at the end of the trust's term. If the grantor dies during the trust term, the assets generally revert to the estate, which is why these trusts are sometimes set up for short terms and rolled over repeatedly to reduce mortality risk. Fact 131. The wash sale rule, which we touched on earlier in relation to stocks, does not currently apply to cryptocurrency. This means that crypto investors can sell a digital asset at a loss to harvest the tax benefit, immediately repurchase the same asset, and still claim the loss, something stock investors cannot do. This regulatory gap has attracted considerable attention from legislators, and proposals have been made to apply wash sale rules to cryptocurrency, but as of 2024 the gap still exists. Many tax professionals expect this asymmetry to eventually be closed as cryptocurrency regulation continues to develop. Fact 132. The tax code contains a provision known as the Domestic Production Activities Deduction, now repealed, that once allowed manufacturers, farmers, film producers, and others to deduct a percentage of income earned from domestic production activities. It was replaced in 2017 by the Qualified Business Income Deduction, which allows eligible self-employed individuals and owners of pass-through businesses to deduct up to 20% of their qualified business income. The Qualified Business Income Deduction is one of the most significant tax benefits available to small business owners under current law, but it comes with income limits and restrictions that exclude certain service businesses at higher income levels. Fact 133. The federal telephone excise tax has one of the more unusual histories in the U.S. tax code. It was originally enacted in 1898 to help fund the Spanish-American War, and it applied to telephone service because at the time, only wealthy Americans could afford a telephone. For most of its history, the tax applied to long-distance calls and was set at 3%. Over time, as telephone service became universal and the distinction between local and long-distance calls collapsed, the tax became increasingly difficult to justify or administer. The IRS stopped collecting it on long-distance and bundled services in 2006, though a small federal tax on local telephone service technically remains on the books. Fact 134. Estate taxes and inheritance taxes are two different things, and they are often confused. An estate tax is levied on the estate itself before assets are distributed to heirs. The estate pays the tax. An inheritance tax is levied on the heirs after they receive their share. The recipient pays the tax. The United States has a federal estate tax, but no federal inheritance tax. However, several individual states do impose their own inheritance taxes. The rates and exemptions vary by state and sometimes by the relationship between the deceased and the heir, with spouses and children often receiving more favorable treatment than distant relatives or unrelated beneficiaries. Fact 135. The concept of a value-added tax, or VAT, is used in nearly every developed country in the world except the United States. A VAT is a consumption tax collected at each stage of the production and distribution chain, with each business paying tax only on the value it adds to the product. By the time a product reaches the final consumer, the full tax has been collected incrementally along the way. VAT rates in European countries typically range from 15 to 27%. The United States instead relies on retail sales taxes collected at the point of final sale, with rates set by individual states and localities, rather than the federal government. Fact 136. The Savers Credit, formerly known as the Retirement Savings Contributions Credit, is a tax credit designed to encourage lower and middle-income workers to save for retirement. Eligible taxpayers who contribute to an IRA, 401k, or similar retirement plan can claim a credit of 10, 20, or 50% of their contributions, up to a maximum contribution of $2,000 per person. The credit percentage decreases as income rises and phases out entirely at moderate income levels. Despite being a meaningful benefit for those who qualify, the Savers Credit is one of the lesser-known provisions in the tax code and is frequently unclaimed by eligible taxpayers who are simply unaware it exists. Fact 137. The standard mileage rate is a simplified method that self-employed individuals and business owners can use to deduct the cost of using a personal vehicle for business purposes. Rather than tracking every expense, gas, oil, tires, insurance, depreciation, the taxpayer simply multiplies the number of business miles driven by the IRS's standard rate. For 2024, The standard mileage rate for business use is 67 cents per mile. The IRS updates this rate periodically to reflect changes in the cost of operating a vehicle. Taxpayers can choose instead to deduct actual vehicle expenses, but this requires much more detailed record-keeping throughout the year. Fact 138. Carbon taxes are a policy tool designed to reduce greenhouse gas emissions by making the burning of fossil fuels more expensive. The idea is economically straightforward. When a price is placed on carbon emissions, businesses and individuals have a financial incentive to reduce their emissions, switch to cleaner alternatives, or find more efficient ways to operate. Several countries and Canadian provinces have implemented carbon taxes. The United States does not currently have a federal carbon tax, though proposals have been debated in Congress for many years. Some economists across the political spectrum view a well-designed carbon tax as one of the most efficient ways to address climate change while raising revenue. Fact 139. The IRS has a simple and rarely publicized rule regarding found property and treasure. If you find money or valuable property and keep it, the IRS considers it taxable income in the year you find it. A famous legal case from 1969 involved a couple who found $4,467 in a used piano they had purchased. The IRS argued successfully that the found money was taxable income. Similarly, if you win a legal dispute over property and receive assets as a result, or if you receive debt forgiveness, those benefits are generally treated as taxable income. The broad principle is that any accession to wealth, any increase in economic value that you control, is presumed to be income unless the tax code specifically says otherwise. Fact 140. The history of the income tax in the United States is inseparable from the history of the country's major wars and economic crises. The Civil War brought the first income tax. World War I brought a dramatic expansion of it. The Great Depression and World War II transformed it from a tax paid by a small number of wealthy Americans into a mass tax paid by nearly everyone with a job, largely through the introduction of payroll withholding in 1943. Each crisis expanded the system, and each expansion left a permanent mark. The tax code we navigate today is, in many ways, a layered archaeological record of every national emergency, political compromise, and economic philosophy of the past century and a half.